So guys, in this video, I'm going to be answering some of the really great questions that I've been getting from all of you lately, starting with this one here from Nafisa, who wants to know if you had to start all over, what would be your top 3 dividend stocks to invest in for a beginner? This is a really great question, and truth be told, if I had to start all over with investing, I'm not sure I'd buy any individual stocks. If I was starting all over again, I think I might just go entirely into ETFs, because I think for anyone just getting started with investing, that really is the best approach. I really think you should learn how to walk before you try to run with this investing stuff. With that in mind, I don't think you can go wrong with a VOO/SCHD split. You guys have heard me talk about this quite a lot here on the channel. This is the same combination I dollar cost average into every week in my Roth IRA. I think these two funds give you a really strong balance between really everything: share price appreciation, dividend income, and dividend growth. And if you wanted to tweak it a little bit, you could swap out VOO for something like VTI, or you could even swap it out for SCHG, something along those lines, and I think it would work pretty similarly. Having said that, I know that some of you are still going to want to dip your toes into individual stocks, and that's totally fine. That's really not the end of the world. But I still think it's best to keep ETFs as the bulk of your portfolio early on, at least like 70% or more, so you can have diversified fund exposure as the foundation of your portfolio. Now, as for individual stocks, I can't tell you specifically which ones you should buy and which ones are going to be the best for you. You'll have to determine that all on your own. But I do think a smart place to start looking is with companies that you already use and companies you already know and interact with on a regular basis. And that's not to say that those will be great investments, but I think that's a great place to start looking, because those types of companies are ones that you'll already be familiar with. And that's a very important thing when it comes to investing in individual companies. You need to know what you own. Think about where you buy groceries, for example. Maybe it's Walmart or Costco or Target. Any of those would be good ones to consider. And what kind of toothpaste do you use? You know, if it's Crest or Colgate, maybe check out Procter & Gamble or Colgate-Palmolive. Also grab your wallet and look at your credit cards: Visa, MasterCard, Amex. These are all great businesses worth considering as well. But anyway, you guys get where I'm going with this. It's a lot easier to follow businesses that you're already familiar with, as opposed to, you know, some others that may be a bit more obscure, like Enterprise Products Partners or Main Street Capital Corporation. Not that those are bad companies, I own both of them in my portfolio, but they're probably not the best starting point for a brand new investor. And with that said, I'd love to get your opinion on this as well. What are some beginner-friendly dividend stocks that come to mind for you? Share them all in the comments below. But anyway, now moving on to this second question, which comes from Joshua. Joshua wants to know, how many stocks are too many for a dividend growth portfolio? 20, 30, 40? And this is another really great question. This is that age-old question: how many stocks should you own? I get this one all the time, and this question is one that investors have gone back and forth on for years, and probably will until the end of time. But the truth is, there's really no magic one-size-fits-all number for how many stocks you should own. It comes down to a few different things, like your investment goals, your portfolio size, and how much time you want to spend managing your investments. That's important too. But with that, there are a few things that you should consider to help you determine how many stocks you should potentially own. And the first one is diversification, and how it even plays a role in your portfolio's performance, because it could have an impact. And breaking that down just a little bit, the more stocks you own, the more your portfolio can start to resemble the broader market. And that's not necessarily a bad thing, but it does mean your returns will probably track closer to an index fund. And on the flip side of that, if you own fewer stocks, your portfolio should deviate from the rest of the market, which means it has more room to outperform, but also potentially has more room to underperform. Either way, it should deviate more from the broader market. And a common rule of thumb that gets thrown around a lot is that somewhere between 20 or 30 different stocks, having more beyond that point doesn't really do much in terms of diversification. It doesn't really add anything more to your portfolio. In fact, some would argue that it could actually hinder your portfolio's performance, because then you're spreading yourself too thin if you have too many different holdings. And at that point, you might ask yourself, would I be better off just investing in ETFs? But anyway, the other big factor is how much time you're willing to spend keeping up with your stocks. You know, if you're holding individual companies, that means staying on top of earnings reports, company news, and other happenings related to your holdings. And that can be a lot to manage, especially during earnings season like what we're going through right now. So trying to keep track of 40 plus stocks would definitely be overwhelming. Speaking personally, somewhere around 20 different stocks is kind of like my diversification sweet spot. And that's about how many I have in my portfolio right now. I think I've got 18 individual holdings. And I think that really gives me a good balance between feeling diversified, but not to the point where I feel like I have too many different stocks to manage. Of course, though, like I said earlier, there's really no magic number and every investor is different. Some investors do just fine having 30 or 40 or even more stocks than that. And then on the other hand, there are investors who prefer to have like less than 10 stocks. Everyone's different. Overall, though, the number of stocks you should own is the number that allows you to balance diversification, manageability, and also peace of mind. And I've come to find that you'll naturally settle into your diversification sweet spot over time. As you get going, you'll get a feeling for where that is. What about you guys, though? I want to hear from you again. What is your diversification sweet spot? Let me know in the comments below. But anyway, now moving on to question number 3, guys. This one comes from R. Redmondi, who wants to know, if the stock price goes up, does the dividend go up as well? And vice versa. I'm a bit confused about why dividends change. And this is another really fantastic question. I often talk about how, no matter what the share price is doing, the dividend doesn't change. But I also talk a lot about how when the share price goes down, the dividend yield goes up. Now, while both statements are true, I do understand how that can seem a bit contradictory. So let's break it down to make it make sense. So I think the best way to explain this is by looking at how the dividend yield is calculated. It is simply a stock's annual dividend per share divided by its current share price. Now, as an example, let's say a stock pays $3 per share at annual dividends and trades at $60 per share. In this case, the dividend yield would be 5%, since 3 divided by 60 equals 0.05 or 5%. Now, as we all know, share prices fluctuate every day. And let's suppose that tomorrow the stock sees a 1.5% gain. Maybe they put out some good quarterly earnings or something like that. But anyway, with that 1.5% gain, the new share price becomes $60.90. Even though the share price has increased, the dividend per share still stays at $3. So even though the share price changed, the dividend per share stayed the same. However, when we recalculate the dividend yield, we get 4.92%, because $3 divided by the new share price of $60.90 equals 0.0492 or 4.92%. So basically, when the share price goes up, the return that you would receive just from the dividend based on the new share price of $60.90 goes down. On the other hand, if the share price were to fall to $55 per share, so it goes from 60 or 60.90 down to 55, the new dividend yield would increase to 5.45%, because $3 in dividends per share divided by a $55 share price equals 0.0545 or 5.45%. And this makes sense because the dividend per share is now higher relative to the reduced share price. To sum it all up, though, the dividend per share, which is the $3 in those examples that we just looked at, the dividend per share doesn't change no matter what the share price is doing. The only thing that changes is the dividend yield. When the share price goes down, the dividend yield goes up. When the share price goes up, the dividend yield goes down. Hopefully all of that makes sense. But anyway, guys, now moving on to question number 4. This one comes from 13baller14, who wants to know, when you started, how much were you investing per month, and how long was it until you started seeing some sizable returns? Man, this is another really great question. So when I first started investing, I think I was putting in about $25 per week, which at the time, for me, I think was the perfect amount. And looking back, I probably could have afforded to invest more than 25 per week. And I have worked really hard over the years to increase my contributions. But I'm really glad that I started small and didn't try and just push it right out of the gate. It gave me time to find my groove and establish some confidence with what I was doing. And I would recommend that to anyone just getting into investing. Start small and start with an amount that feels comfortable. Something manageable that won't stress you out, because investing can feel overwhelming when you're new to it. So don't feel like you need to go all in right away. Just take your time, learn as you go, and know that you can always increase your contributions over time. And you should work toward doing that. Like I said, that's exactly what I did when I started. I got going with $25 per week. Then at some point I bumped it up to $50 per week, and then $100 per week, and so on and so forth. And now at this point in time, I'm investing $250 every single week into both of my accounts, my taxable account and my Roth IRA. And I hope to continue increasing that even more as time goes on. Like, one of my goals by the end of 2025 is to increase my contributions to $325 per week. That's what I'm shooting for. Now, as far as when I started seeing some sizable returns, there were a couple of moments where I feel like things really started to noticeably pick up. The first big milestone was when I was consistently bringing in over $100 a month in dividends. There was just something about seeing that 3 figures a month rolling in without having to lift a finger. It really drove home the power of dividend investing. And at that point, things started to feel like they were growing faster. And I know $100 isn't like a life-changing amount of money, and inflation has certainly chipped away at that over the years. But even today, at least for me, $100 a month can still pay some bills, it can pay some groceries, or it could pay for a couple of trips to Juan's Flamin' Fajitas for me and my wife. And knowing my investments were generating that on autopilot made a big impact on my mindset and really motivated me to hit it harder. Now, the second time that I really started to notice the impact of the snowball effect, I mean, I've really noticed it more lately as my portfolio has started to approach the $100,000 mark. Right now I'm at about $92,000. And I would say that since about 80K, I really started to notice some big swings in the daily value fluctuations. With where my portfolio is at now, it's completely normal for the daily movements to swing hundreds of dollars per day. Like on the low end, I'm either up or down $100 at minimum. And on really good or bad days, it can actually move by $1,000 or more, which is wild to think about. And I know this dividend investing stuff starts out pretty slow and it's hard to get excited about it at first, but you will reach a point, and it will happen sooner than you think, where that dividend snowball really starts to take off. And that's what I'm telling you about in this next video right over here. I'm gonna show you where this point is and what it's gonna take to reach this point in your own investing journey. So click right over here to check that out, and I'll see you in the next one.